Most people think they understand the meaning of growth. They imagine booming industries, rising incomes, technological breakthroughs, and a global economy that expands naturally as humans innovate and progress. But what if everything we associate with economic growth is not the result of natural forces at all? What if the system of growth we trust is an illusion carefully engineered, maintained, and protected by those who benefit most from it? And what if the real engine behind growth has nothing to do with productivity or innovation, but something far more fragile and far more controlled? The idea of growth has become so deeply embedded in modern thinking that most people never question it. Governments promise it, investors assume it, and societies depend on it for stability. Yet behind the scenes lies a structure designed to ensure that the story of growth continues, even when the fundamentals of the economy say otherwise. To understand how that illusion was built, we have to trace its origins through policies, institutions, crises, and interventions that quietly shaped the world we live in today. Long before modern capitalism, economic expansion was tied directly to physical output. If a society grew more crops, mined more metals, or produced more goods, its economy grew. Growth was slow because it relied on material limits. But as global trade expanded and early financial systems evolved, something changed. People began treating the promise of future output as if it were real wealth. Debt, speculation, and credit started acting as multipliers, creating the appearance of growth long before the real economy could catch up. This shift became foundational for modern economies. Banking families and early financial elites discovered that by lending money, they could profit from economic activity that hadn't yet occurred. This system worked as long as people believed in future expansion. Growth became less about what a society produced today and more about what it could be convinced to produce tomorrow. Once this expectation took hold, an entirely new game began, one built on confidence, leverage, and the ability to control narratives. By the 17th and 18th centuries, governments realized that financial engineering could achieve growth on paper even when real production lagged behind. National debts expanded, bond markets grew, and central banks emerged as new power centers. The Bank of England, founded in 1694, pioneered a model in which the state and private financiers worked together to create money, manage debt, and stimulate expansion. This didn't just fund growth, it manufactured it. Throughout the Industrial Revolution, this illusion grew stronger. Massive borrowing funded railroads, factories, and shipping networks. Productivity increased, but so did dependence on financial expansion. The true turning point wasn't the factories themselves. It was the belief that economies must expand every single year, regardless of natural cycles or limits. Growth became an expectation, a political promise, and eventually a societal requirement. By the early 20th century, the illusion of growth had become ingrained. Governments fought wars with borrowed money, rebuilt with borrowed money, and stabilized their economies with borrowed money. The First World War created mountains of debt that many nations couldn't repay. When the post-war economy slowed, countries faced a choice: acknowledge the limits of the system or find new ways to sustain the illusion. The Great Depression revealed the fragility of this system. When credit dried up and asset prices collapsed, the illusion of endless growth evaporated overnight. Factories shut down not because consumers suddenly stopped needing goods, but because the financial system could no longer pump enough credit into the economy to sustain expansion. The crisis demonstrated a brutal truth. Economic growth could collapse simply because confidence collapsed. Instead of rethinking the system, policymakers doubled down. During World War II, nations borrowed on an unprecedented scale, creating massive demand through government spending. This artificially stimulated growth and revived industries, but it also deepened dependence on debt-driven expansion. After the war, world leaders faced another challenge: how to stabilize a global economy now built on artificial growth. They met at the Bretton Woods Conference in 1944, establishing the IMF, World Bank, and a new dollar-based global monetary system. These institutions were designed not only to stabilize international finance, but also to preserve the illusion of perpetual growth. With the US dollar tied to gold and other currencies tied to the dollar, Global trade could expand smoothly, but only as long as countries accepted the framework created by the financial elites of the time. For a while, the system worked. Post-war growth looked impressive, but much of it was fueled by government spending, easy credit, and financial coordination. The world appeared to be thriving. Yet beneath the surface, imbalances were building. Countries borrowed to sustain growth, corporations borrowed to fund expansion, and consumers borrowed to maintain rising living standards. Growth had become dependent on credit, not production. By the late 1960s, the illusion began to crack. The United States was printing far more dollars than it could back with gold, and foreign nations sensed the imbalance. As countries demanded gold in exchange for their dollar holdings, the system faced collapse. The world was on the brink of discovering that its economic growth had been built on a promise that could not be fulfilled. In 1971, President Nixon made a decision that transformed the global economy forever. He ended the convertibility of the dollar to gold. This move severed the final link between money and physical value. With currencies now floating freely, financial elites gained unprecedented power. They could expand money supply, manipulate interest rates, stimulate markets, and generate the illusion of growth through financial mechanisms rather than real production. From the 1980s onward, deregulation supercharged this new system. Banks were freed to create complex financial products, credit expanded exponentially, and stock markets became engines of speculative profit. Growth numbers looked strong, but much of it was inflated by asset bubbles, leverage, and artificially low interest rates. The financial sector became the heart of the economy, even though it produced nothing tangible. Developing nations were drawn into this system as well. They were encouraged to borrow heavily, open their markets, and integrate into global finance. As they did, they became dependent on capital flows, controlled by international investors and institutions. Growth in these countries often appeared rapid, but it was frequently driven by external borrowing rather than internal productivity. And when crises hit, as in Latin America in the 1980s or Asia in 1997, the illusion vanished instantly. The technology boom of the 1990s reinforced the illusion once more. Stock valuations skyrocketed not because companies were profitable, but because investors believed they would be someday. When the dot-com bubble burst, trillions in paper wealth evaporated. Yet instead of questioning the system, central banks intervened, cutting interest rates, injecting liquidity, and propping up markets. Growth was rescued again, not through production, but through financial engineering. The 2008 financial crisis exposed the illusion on a global scale. Banks collapsed under the weight of their own debt-fueled expansion. Consumers defaulted on mortgages they were encouraged to take. Governments stepped in with massive bailouts, financed by more debt. The illusion was preserved, but only through extraordinary intervention. Growth resumed. Yet the underlying system became even more fragile. After 2008, central banks introduced quantitative easing, creating trillions of dollars to inflate asset prices. Stock markets soared. Real estate boomed, and corporate profits surged, but wages stagnated, inequality widened, and productivity growth slowed. The economy looked healthy on paper, yet for millions of people, daily life became harder. Growth existed in statistics and financial markets, but not in reality. By the 2010s, much of the world's economic expansion came not from new inventions or productivity, but from expanding debt. Corporations borrowed to buy back their own shares. Governments borrowed to fund basic services. Consumers borrowed for housing, healthcare, and education. The illusion of growth had become so complete that any slowdown had to be countered immediately, often with policies benefiting those already at the top. The pandemic in 2020 pushed the system into overdrive. Governments printed trillions to prevent collapse. Markets boomed, even as economies shut down. Billionaires added trillions to their wealth, while millions lost jobs. Growth statistics became unmoored from lived reality. The illusion was not just maintained, it was reinforced on a scale never seen before. Today, global debt exceeds $300 trillion. Central banks controlled more assets than ever. Stock markets remain detached from economic conditions. Housing prices reach new highs, even in struggling countries. Growth continues to be treated as a sign of prosperity, Yet most of that growth exists within financial markets engineered by powerful institutions. This brings us back to the mystery raised at the beginning. Why does the illusion of growth persist, even when the fundamentals suggest otherwise? The answer is simple but unsettling. The modern economic system requires growth to stay stable. Without growth, debts cannot be repaid, markets collapse, and political systems become unstable. For elites who own financial assets and influence policy, preserving the illusion is essential for maintaining control. Every major crisis has been met with interventions that protect markets, preserve confidence, and maintain the appearance of expansion. Real productivity matters far less than the ability to manipulate financial conditions. Growth has become a narrative one crafted by policymakers, central bankers, and institutions whose power depends on sustaining it. From this story, three key takeaways emerge. First, modern economic growth is not purely organic. It is engineered through financial mechanisms that benefit those who control them. Second, the gap between real economic conditions and financial indicators is widening, making future crises more severe. And third, understanding the illusion of growth is essential for understanding where the world is headed. If this exploration gave you a new perspective on how the global economy truly works, consider staying connected with the channel. The more we question the stories we're given, the better prepared we are for the changes shaping our future.